Welcome to Business with Louis, the show where we explore the latest trends and insights in the world of entrepreneurship and business. Today, we're going to talk about how credit scoring systems are evolving and what this means for lenders, borrowers, and entrepreneurs alike. To start, let's define what credit scoring is. Simply put, credit scoring is a way of evaluating an individual or business's creditworthiness based on their past behavior and financial history. This information is used to determine the likelihood that they will repay debts on time. Credit scores are usually calculated using a combination of factors, including payment history, credit utilization, length of credit history, and types of credit used. In short, they help lenders make informed decisions about who to lend to and at what interest rate. This is crucial for entrepreneurs and small business owners, as access to capital can be a major hurdle when starting or growing a business. By understanding how credit scoring systems work, entrepreneurs can take steps to improve their own creditworthiness and increase their chances of securing funding. So, where did credit scoring come from? The concept of credit scoring has been around for decades, but it wasn't until the 1980s that the modern credit scoring system was developed. This was largely driven by the introduction of the FICO score, which is still widely used today. Since then, credit scoring systems have continued to evolve, with new models and technologies being introduced all the time. One of the key principles underlying credit scoring systems is the idea of risk-based pricing. This means that lenders use credit scores to determine the level of risk associated with lending to a particular individual or business. Those with higher credit scores are seen as lower-risk borrowers and are therefore offered better interest rates and terms. On the other hand, those with lower credit scores may be considered higher risk and may face stricter terms or even be denied credit altogether. One notable trend is the use of alternative data sources to evaluate credit worthiness. For example, some lenders are now using social media data, online behavior, and even rent payments to get a more complete picture of an individual's financial situation. This can be particularly helpful for entrepreneurs or small business owners who may not have a traditional credit history. Another example is the use of machine learning algorithms to analyze credit data. These algorithms can identify patterns and trends that may not be immediately apparent to human analysts, allowing lenders to make more informed decisions about who to lend to. For instance, a study by the Harvard Business Review found that fintech companies using machine learning algorithms to analyze credit data can reduce default rates by up to 50%. In addition to these examples, research has shown that small businesses and entrepreneurs who understand credit scoring systems are more likely to secure funding and achieve long-term success. A study by the Federal Reserve found that small businesses that use alternative credit scoring models are more likely to receive loan approvals and experience faster growth rates. So, what can entrepreneurs and business owners do to take advantage of these evolving credit scoring systems? First, it's essential to understand how credit scores work and what factors affect them. This includes maintaining a good payment history, keeping credit utilization low, and monitoring credit reports for errors. Second, entrepreneurs should be aware of the different types of credit scoring models available, including FICO and VantageScore. They should also consider using alternative data sources, such as rent payments or utility bills, to demonstrate their creditworthiness. Third, business owners should stay up to date with the latest developments in fintech and credit scoring. This includes attending industry events, reading relevant publications, and following thought leaders in the space. By staying informed, entrepreneurs can make more informed decisions about their financial future and take advantage of new opportunities as they arise. Finally, it's essential to remember that credit scoring systems are just one part of the larger landscape of business finance. Entrepreneurs should also be aware of other factors that can impact their ability to secure funding, such as cash flow management, revenue growth, and industry trends. In conclusion, the evolution of credit scoring systems is a critical development in the world of finance, with far-reaching implications for lenders, borrowers, and entrepreneurs alike. By understanding how these systems work and adapting to changes in the market, business owners can make more informed decisions about their financial future. As my experience with market cycles has taught me, staying ahead of the curve requires continuous learning and a willingness to adapt. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.